And we're live. Welcome everyone to a co-hosted webinar between Startup TNT and BDC. Topic for today, what does 2021's record-breaking year mean for your valuation? And we've got three esteemed panelists here ready to talk about this for the next hour. But before we get to that, I want to meet one of BDC's new members, Jean-Luc Begaud. Did I get your name correct?
Solid attempt. It was so close, so close. It's a silent D at the end. Jean-Luc Begaud, but I appreciate it. Thanks so much for having me, Zach. Appreciate it.
All right, Jean-Luc, we're meeting for the very first time here at this webinar.
Yes.
Tell us a little bit about what you do at BDC.
Yeah, you bet. So newest member of the team here, and I'm really excited to join the Edmonton ecosystem here in tech with all the entrepreneurs and all the exciting people, especially, just meeting you here and seeing what TNT is about. Really excited to be a part of that. So part of the non-dilutive financing team specifically for tech companies here in Edmonton. We're across the whole prairies too, so not just here in Edmonton, but I'm looking forward to helping out locally here.
Okay, awesome. And so what types of services can entrepreneurs expect when you talk about non-dilutive financing from the BDC team?
Yeah, good question. I probably could have gone into that a little bit more. But so essentially what we're looking for is helping out these entrepreneurs at that stage where they're trying to access some capital, but they typically at that stage have to, look to outside investment, sell off their equity. So we're looking for those companies that we do see a future growing in Canada, some scalability, and really helping them access that so they have a little bit more control over their own equity. And at the same time, just helping them along, directing them in the right direction. If they need help with other, introductions to government assistance, we help out there, even just give guidance because there's, it changes so rapidly out there. So being a connection to the ecosystem and what's available is kind of how I see myself moving forward, and then hopefully providing some of that financing for them.
Well, thank you, Jean-Luc, and it's great to have you in the Edmonton ecosystem. I will point out, Jean-Luc, great place to meet entrepreneurs is every single Thursday at Startup TNT. We've got a very special night coming up this Thursday, the Life Sciences Investment Summit, where we will be investing live right before your very eyes in at least one life sciences startup. So I hope you can join us for that. I hope everyone can join us for that. It's going to be a great evening. Okay. Thank you so much, Jean-Luc. Let's get on and meet our panelists. Up first is someone from BDC. It is Brenda Slauko. Brenda, you've been with BDC for a very long time. Please say hello. Tell us a little bit about your background.
Hello, everyone. Yes, I have been with BDC for 26 years. So it's kind of on the other side of JL, who's just 2 months in with us. The strengths I bring, having been with the bank for 26 years, is I know everyone pretty much at this bank. So if you're trying to figure out who to connect with and when to connect with them, I'm good at helping navigate that, as well as my expertise in all sorts of funding. So not only have I supported companies with debt, subordinated debt, mezzanine, and straight equity. So I have that background of knowing when we're talking to tech companies, perhaps what is the best instrument to be used, the strengths and weaknesses of all the different instruments, to be quite honest. And then I get to lead this very small but mighty tech team in the prairies in this non-dilutive funding world. So we have Jean-Luc in Edmonton, we have E.B. Lacani in Calgary, we have Tommy Norgard in Saskatoon, Katina Wall in Winnipeg, and then everyone knows Tara Benson. So that's our team. If you don't know a member of this team and you're a growing, scaling tech company, you should connect with one of us. Find us on LinkedIn, we're there, and make sure you're talking to us.
Yeah, thanks, Brenda. We've met most of your team now through TNT. Great people. Great to have you guys as one of our sponsors. All right, let's go to one of our other panelists. How about Mike Wilson, founder and CEO of Drugbank, who raised money at our very first Startup TNT Investment Summit. Mike, how are you doing today?
I'm doing very well. And I'm the founder and CEO of Drugbank. So Drugbank's a pharmaceutical information database. Basically, we provide information about drugs and how they work for companies doing machine learning in drug discovery or precision medicine. We have customers around the world, and we have more than half of the top 20 pharmaceutical companies as customers to date. And we've been growing a lot since the first Startup TNT Investment Summit, and it's been great to be working. Well, it was fun to be a guinea pig for that event, and I'm really excited to see how much Startup TNT has grown since then as well.
Well, thanks so much for joining us back then, Mike, and thanks for joining us today. Now, is it true that you have used yourself some of these BDC non-dilutive funding services? Did I hear a rumor?
Yep, that's right. Yep. Yeah, definitely. We try to get a mix of different types of capital. Obviously, you mentioned we've got investment, which is dilutive funding for equity. And we've also leveraged some grants, of course, things like IRAP. And then BDC is another important part of that mix. So we got a loan from BDC for scaling. So that helped us to kind of ramp things up further with some of our hires on the sales team and just help us keep growing faster. So we're always looking at these different sources of capital as ways to just keep accelerating growth. And yeah, BDC was really good to work with on that front.
That's great to hear, Mike. Okay, and our final guest is actually someone that has invested directly into Drugbank, someone that invests in a lot of great local companies here in Alberta. It is Arden Say. Arden, how are you doing today?
I'm doing well, thank you very much, despite the broken ankle that I'm sure if you know about, but yeah, doing well, thanks.
How did you break your ankle? This sounds important. What happened?
Nothing exciting. I wasn't fighting for freedom or chasing down a truck or anything like that. I just slipped on the ice here in Edmonton about a month ago, and then I fractured my ankle, which required some surgery and a plate. So it's been fun. I mean, getting to work from home has been key to recovery. But yeah, I'm doing all right.
Yeah, just a classic Edmonton ankle break story right there.
Pretty much.
Okay, tell us a little about your background, though. You know, you're in the VC world now, but I know that you have a lot of experiences under your belt. Tell us.
Yeah, so I've pretty much been in capital markets and investment management for probably over 15 years in commercial real estate, public equities, everywhere from private industry and brokerage all the way to federal government, AIMCO, and now in venture with Yaletown Partners. And so, you know, I tend to take a bit more of a macroeconomic look, a view of things. And venture has been a really interesting, exciting area for me. And, you know, connecting the dots between what's happening in the world economy and markets to, you know, how we do our jobs here locally. That's I really like to get paid to do that, you know, every day. It's an area I naturally think about anyhow.
And, you know, one thing that I always think is really quite unique to your background as a venture capitalist is that you used to run venture mentoring services. So you kind of got this like awesome framework for mentorship as part of that you bring to the venture capital industry.
I did indeed. And so that's actually what got me introduced into the startup community and into tech. That exposure was through the VMS program and managing that. And so yeah, again, it's very fortunate when you get to combine everything you've done and know into a career. And I feel like none of that time was wasted in this kind of meandering career path that I've had. But I'm currently with Yaletown Partners. I've been there for 3 years, and we have a couple of different funds. Our flagship fund, Innovation Growth Fund 2, is going to be closing on a $200 million. And that's kind of a growth Series A, Series B level investment fund. And then I manage Accelerate Funds 2 and 3, along with a couple of the analysts in our pool, Yasmin Al-Hussein, formerly of Startup TNT, and Melania and Tosco, who's in Calgary. And so we're in the market, and we invest in early stage B2B tech startups here in Alberta, and you know, got some early revenue, et cetera, but don't need to pitch too much for our fund. Here to chat about the economy and the markets.
You know what? I think let's get into it. Let's get into what's going on today. Let's talk about global trends in the VC industry and how that's impacting valuation. And then we're going to talk a little bit about, generally speaking, how to approach valuation. We've got some great local expertise right here to share their insights. So I'm going to share my screen. I'm going to encourage people that are on the call to share questions in the chat. Jump right in. Tell us what you're thinking about. Tell us what questions you have. We got great expertise right here. All right, so let me bring up a slide. Is everybody looking at the right slide? Okay, Canadian tech companies are attracting international attention. I'm going to throw this to Brenda first. I look at the trends on this graph, Brenda, and I see that the amount of capital that is coming from Canadian VCs over the last 10 years has gone from 70% roughly of the VC investments in Canada down to less than 40% or so. Is this a good thing? What's going on here?
Well, it is a good thing, actually. What it's saying is our Canadian tech companies are doing great, and we're attracting international investors like never before. I think we need to put it in context of what the heck happened in 2021. We saw over 1,000 venture capital deals in Canada. And that means $12 billion were invested. That is huge. compared to our previous record-setting year in 2019, we saw $6 billion investments. So almost a doubling in the dollar amounts. So no doubt the international investors saw what was happening up north, and they've come and they are driving up those valuations. A lot of them, Arden and I know, like Tiger Global, they came up here and they set these valuations and pretty high compared to what we're historically used to seeing in Canada. So on the valuation side, the Canadian investors had to decide whether they were going to get on this bandwagon and follow or miss out on the deal. So there's been a lot of hype and exciting to see all this investment coming internationally. I think if you want to flip to that next slide, Zack, on the investing opportunities globally, we saw like a doubling of investment by VCs into tech companies, but in Canada it was a tripling from last year. So it's definitely seeing a rapid increase. So we're wondering who's behind all this money, and there's a lot of money. So when you think of historically in the venture capital ecosystem, we had something like 220 billion last year to invest. Well, all of a sudden we have what we're kind of coining as like these non-traditional investors, the non-VCs. So we're talking hedge funds, mutual funds, private equity going downstream, family offices, and more corporate strategics coming on into the market. And they are bringing like 350 billion more money, additional money. So there is a lot of dry powder to invest. So having a doubling of the capital is what's creating the fight for all these great deals. And there's not a lot of deals out there, right? There's still only a certain number of companies. So that's what's been really driving up all this activity. It's exciting for all our venture capital investors, I'm sure, to try and fight it out, looking at Arden. But so exciting for the tech companies. It's definitely 2021 was a founder's market, for sure.
Interesting observation there, Brenda. Significant increase in the amount of capital available to invest in companies, perhaps far outpacing the number of companies that are forming in our community. Maybe we'll get Arden's take on this. Arden, what are you seeing, especially maybe if you can bring it back locally here in Alberta? Are you seeing this on the ground where a lot of like US-based or international investors are going in on deals, and what are you seeing?
Yeah, I definitely have noticed investors from outside of our ecosystem, particularly in the US, poking around and being on the cap tables of a number of deals that we're looking at. We've been approached as an early stage fund here in Alberta, to share deal flow from, I've personally been connecting with VCs in New York, as well as out of the Valley and Texas as well. So there's definitely interest for a number of reasons. Now, yeah, valuations are going up, and you're going to hear, a lot of fellow investors who are worried about that, and it is a tricky time. But the fact of the matter is, it is what it is. This is the environment we have to work in, which is not the same as it would have been 10 or 15 years ago when there were different things you had to contend with. And I think the important thing to remember with the, Tiger Globals of the world is they're playing a different game, and that not every investor, but most of us, in fact, all of us who aren't backed by a hedge fund, don't have the tools to keep up, nor should we, right? I mean, I think the fundamentals are still the same, and the challenges for VC investors at every stage right now is that finding that balance of where you sit between the world of, I'm really careful on valuations because math matters, but I may miss out on deals, versus we got to get in at all costs because we have capital to deploy. And even if we don't make our multiples, at least the money's out there and we don't miss out on a deal. I think both are equally valid concerns right now. And nobody, has the right answer. Nobody has, we'll all find out if we're right in about 10 years. But right now, what's important for investors is to have a discipline and to stick with it. Otherwise, you're really going to be either stuck not knowing when or where to deploy a check, or you'll be overpaying far too much and having everything crater, or not being able to guess. So it is a tricky time, but that's what we get paid to do, is to have our own perspective and view in the world and to stick to it. And that's what our investors are trusting us to do.
Arden, both you and Brenda touched on something that I think a lot of us maybe don't fully appreciate, which is like basically new players entering this VC industry. You mentioned private equity, you mentioned Tiger Global. Can you guys expand a little bit? Like, what do you see happening in terms of like people that maybe were traditionally in the private equity now going to VC? Can you just expand on what's happening out there?
All right, this is my 5 minutes or less explanation of what's going on in the capital markets. Okay, so really, when you look at the broader picture, there's three things going on at a high level. So in the public that have really kind of pushed what's happened to, I would say, the end of last year, maybe early part of this year, and we're already seeing market forces changing. So this could actually switch on a dime by next quarter. But really, when you look at the activity in 2021. At a very high level, at the public markets, we had a huge infusion of public money. We had all these SPACs forming. There was capital chasing deals. And so there was a lot of, just basically a lot of dry powder in the public markets. In the private equity space, we have the Tigers and the SoftBanks and there's like at least, I would say, 6 to 8 private equity firms that have kind of gone upstream to invest in earlier stage companies. Now, there's a whole strategy behind that. They're essentially indexing the private markets based on what they've seen. I can dive into that a little deeper later, but the point is you have all these companies that are actually backed by a lot of public equity money, that they've made. Tigers they're, I think, at 95 billion now under management, and more than 2/3 of that is in public equities and hedge funds. And then they've got, about a dozen or more venture capital funds that, interestingly enough, when you look at it, they don't have a lot of institutional LPs in them. Most of their funding comes from, I would suspect, from their own employees, ex-employees, and fund managers. Don't forget that founder at Tiger invested in 30 or some odd ex-employees of Tiger and funded them Tiger Cubs. Anyhow, so that's a completely different story down the road. If anybody's interested, happy to chat another time. And then you come down to the early stage level, right? So you've got all of these entrepreneurs over the last 5 years that came from, or people who left Uber, WeWorks, because they were there early, or they've had their exits. When you go on VC Twitter, the running joke is, if you have a Twitter handle, a big audience, and a Substack, and some money in the bank, you're now a VC. And a lot of these VCs have never invested in the public markets, or they don't necessarily connect the dots between valuation you give now to later. And so, this is an observation made by a number of us in the industry, right? And so you get these earlier stage investors writing pretty lofty checks because of their conviction in the company. So when you combine those three factors, it's never one thing, right? So there's kind of this perfect storm of capital. At the same time, that also means it can be precarious, and that balloon could pop depending on a number of factors.
More money in there. I like that expression, indexing the market. It sort of implies that they're just trying to get on every feasibly good deal that they can find.
They're playing Moneyball.
Much less selective.
Yeah, they're playing Moneyball. Their Internet Fund 4 and Internet Fund 5. The one, so everybody hears about 358 investments made last year, et cetera, et cetera. When you look into it, that's out of a fund that was formed in 2016. And they ramped up most of their investment last year, and they have just as many companies in that portfolio as the S&P 500.
Jeez.
So when you look at it, all signs point to this is the strategy.
Yeah, but they were doing, we figure, like a deal a day. And so you're wondering how much due diligence can possibly go into that. Yeah, exactly.
Well, Mike, how's this translating for you? Like, are you just like minding your own business and like VCs are cold calling you and saying, I want to invest, take my money now? Like, how's this happening for you?
That happens sometimes, yeah. But the I think, one of the things is you have a lot of there's a lot of investors, but of course they all have their own thesis and stuff. So you also need to be careful with, your own time. That's a very valuable asset. So you can't literally talk to 10,000 investors, even though there might be 10,000 investors. So you also have to try to kind of selectively pick the ones to focus on, and that. That could be tricky because I was looking through lists of 500 investors, and you're trying to figure out which ones might be a fit, which ones are definitely not a fit that you can eliminate before you talk to them. So that's definitely an important part of it. Even though there's lots of money, everyone has their own thesis and hypothesis, right? So that's important. For me, the other thing is it's very easy to make connections now internationally. I think part of this. Maybe part of the international money coming in is also just how normalized it is now to do, Zoom call meetings with investors and stuff like that as well. You don't necessarily have to fly there and meet them. And so you can actually meet someone in New York, then meet someone in San Francisco the same day very easily now. So I think that also makes people maybe less wary of, before there's always this big push. Oh, you got to move to San Francisco. You got to move to San Francisco. But people kind of don't say that as much anymore these days. And so that's something I've noticed as well.
Yeah. Excellent to hear, Mike. And I agree with you. I don't think you need to move to San Francisco. You can build great stuff right here in Alberta.
Mm-hmm.
Arden, I'm curious, if you look at the data from the Accelerate Fund over the last few years, are you seeing like median pre-money valuations creeping up significantly in the last couple of years due to all this activity, or is your portfolio holding relatively steady?
I would say that the trends are twofold. One, we're seeing follow-on investments happening faster, so deal velocity is happening a lot faster.
Okay.
I'll give you an example. In Accelerate Fund 2, the first follow-on financing we did was in like year 5, I believe, year 4 or 5 of the fund, right? So it took some time to get there, they were growing, etc. In Accelerate Fund 3, we had our first follow-on financing within a year of investing at a pre-seed, like an early stage company. And a US VC came in and they put in like, $10 million US into the company. On paper, it was great for us. And it is in a fast, high growth industry. And so, I think that it was certainly warranted. But definitely valuations are creeping up, not as fast as other markets, because I think we're a little bit insulated here from obviously markets like Toronto and Vancouver, or even down in the US, but it has been happening. I think what it comes down to, though, is we look at every deal on an individual basis and ask ourselves if it makes sense, because we are in the math still matters camp. And so my look at evaluation really depends on our team, and our philosophy is, well, what's the potential exit number going to look like? We do our research on comparables, where we think the market's going to go in the next 4 to 6 years, because that's the environment we're exiting under. And then we kind of work backwards to say, yeah, that makes sense for us, or no, that's way too expensive and there's just no way realistically. I mean, the chances of us being able to get a number that we need are really, really low, because if you're doing like a $70 million pre on a series, call it a series seed or a series A, we're seeing some seeds at the, at the $40-50 million level. And your likely exit, when you look at the market, is in the quarter billion dollar range. That's not a lot of room for us to kind of get the multiple we need to make our fund. So it's a case by case approach.
Yeah, that's a great way to think about it. I know, Arden, you did some education sessions for us at TNT that really helped me think about it. Instead of thinking about the exit 5 or 6 years from now, just think about the next 18 to 24 months and like, is the company going to hit new milestones to raise a valuation, make the company and the investors all happy on the same page.
Well, and Zach, it's a good point right now, because even like look at the public markets and those companies that are not living up to their expectations or their potentials, and how hard they've been hit. So at an early stage, it's equally, if not even more important, to hit all those milestones, because what we don't want to have happen, and which we might start seeing, are those down rounds coming. Because can these companies actually grow into these inflated valuations? Inflated, depending on what they were portraying. Can they grow into them or not?
Yeah. Well, Brenda, I actually was going to go to you next anyways to maybe talk about this particular topic. We're kind of all talking right now about what happened in the last like 18 to 24 months. But if we look to the future, is there any reason to be skeptical that this trend is going to continue? Is there any headwinds we're facing? You kind of just hinted at one with the public market.
Yeah. Like the public markets, the first 2 months of this year, there's been a lot of headlines, and they're not all positives, right? Like CEOs being replaced, these valuations, as I said, the expectations of the profit or even just the sales growth, the traction's not been there. So there is definitely headwinds coming for those later stage, for sure. But the later stage is like the series C's and D's is where we saw the hockey stick growth in the median and the average size valuations. Like they went from 50 to $60 million kind of valuations, where at the earlier stage where we tend to play in Alberta in our ecosystem, there's still quite a few early. It wasn't as hyped up, the valuations, right? Unless you're in one of the hot industries. So when you go from maybe a $2 to a $5 million valuation, that can be absorbed. You can grow into those. We're still a little bit more realistic or pragmatic here in Alberta, I would say. So yeah, but there's definitely, we're seeing up at the higher ends, later stage, seeing those valuations start to get affected and come down. So now I think Arden and I are wondering how or when will that trickle down to the earlier stage, Series A and seed level. And what are we going to see for valuations there? There's still lots of money, though. That's the one thing. It has not all been absorbed.
There's two. Here's the themes that we're grappling with, right? Is that on the one hand, private markets typically, take their cue from the public markets, and the question is, how long will it take to catch up? And there's a lot of sentiment out there that we're just so awash in private capital. It's kind of like a game of musical chairs. Can you get out before the music stops, right? And there is a lot of private capitalists keeping things going that keep a company from needing to go public. That's just been a trend. But on the other hand, when you actually look at the data of the last decade or more, I was actually just researching this on PitchBook not too long ago, the more extreme the swings in the public markets, the tighter the correlation is between public and private markets. So now you have this history of what's going on, butting up against this new thing of all this private money out there. And it's really anybody's guess. I'm not going to sit here and say I know. I just know that again, as an investor, our firm's philosophy is it's coming and we're being very careful. And I think it's not the end of good times as we know it, perhaps, but it's no longer going to be, you get a high valuation, you get a high valuation. The Oprah Winfrey days of high valuations are gone. You're going to need to be a well-run company with the proper metrics, right? And some will get it. I mean, the value of a company is really what someone's willing to pay for it. So it depends on how they analyze it. When we invested in Drugbank, we looked at the revenue growth, the trajectory, the team, and we realized this is a strong company that we can get behind, and the valuation was fair and we were willing to pay for it. We wouldn't necessarily have paid the same valuation for a company that wasn't growing as strongly or wasn't in such a big market or had such strong IP. So my message to entrepreneurs is, as always, build a really good company. Don't rely on the general trends in the markets to try to command a large valuation, because that may have worked in the last year or two. Investors are going to be sharpening their pencils, and we're going to be looking at, probably more investor-friendly terms to protect downside going into the future. So just come in, and have a good understanding of what your business is.
Yeah. Let's go to Mike on this, because actually, as I recall, Mike, you were in the middle of closing your first round of funding 2 years ago, right as the pandemic hit. So I'd be curious to hear about your experience. Like, how did you approach this valuation question? If we can bring this down to some practical advice for a lot of the entrepreneurs on the call. It's kind of probably the most daunting task a lot of entrepreneurs face. So can you walk us back to how you approached it back then?
Yeah. It's a tricky one. And I mean, even today, when we're talking about the high valuations, it's always, you have multiple variables that you're trying to optimize for. And maybe going for a really high valuation might limit the types of investors you can bring on, or looking at investors that add value. That's another part of the equation, and looking at the kind of options you have in the future too, right? If you go for an extremely high valuation, maybe you get a great acquisition offer in a couple of years, but it's not great for the investors, so it's not really on the table, right? So it definitely can limit your options as well. It's a tricky thing to do, but obviously looking at comparables is important. When you have revenue, that's an important thing. You want to basically make a case for your valuation and be able to argue it. And so you might have certain parts of your business that you actually think are a pretty high value, but they're just harder to make the case for right now. And so you might choose to undersell the value of that piece and try to make a really solid case on another area. So, I mean, if you have revenue, that's always looking at multiples of revenue is always a very nice and easy type of comparable to justify valuation. But usually you want to get, ultimately what you're trying to do is get alignment on this company is going to be worth more in the future, and the amount you're paying is a deal on that future value. And so, how you want to find convincing ways to tell that story basically is what it comes down to. And what that story is for each company depends on the nature of the business, right? It could be, there's some companies have no revenue, but they have very high value, well-protected IP. So, there's potential for this large market. They could raise great valuation before they have any revenue. Other companies in the SaaS space, revenue is really important. There's tons and tons of material out there about everything to do. There's always these things around this is how you write the perfect pitch. This is how you do the perfect. Usually if it's completely black and white, then it's probably not entirely true. It's never quite that simple. No one can just say this is exactly how you do it. So, but that's what it comes down to, is understanding your business. And to really get a strong story, you have to try to find the weaknesses yourself first. So try to get advice from people and say, here's my angle on the valuation. Is this good? Hopefully find some people who have experience investing that aren't necessarily going to be investors, and they could maybe give you some mentorship and poke some holes in it. It's, the more that you can do that before you're actually in front of an investor, the stronger you can make your story, the more likely you can actually get the valuation you're aiming for, et cetera. So
is that how it worked for you? Arden wants to speak. Arden, you go ahead. I got a follow-up question for Mike.
Okay, I was going to throw in there to kind of add on to what Mike is saying. Every company is different. Every investor is different as well. And I think especially earlier stage entrepreneurs would do well to understand the difference between angel investors and, well, even angel funds, as well as venture capital investors who are managing pension fund money or government money. Every investor has different requirements, and venture capital is a very narrow kind of a model and path. So you need to understand if you can give that kind of growth to attract an investor. I've often seen companies that will pitch to do the same pitch to angel investors as well as, or will come into a round after the angels have invested. And angel investors, they have all kinds of motivations and math that may or may not matter to them. They might be like, if you can double my money in the next 10 years, I'm happy. I'm here to support you. So I'll give you whatever valuation you want. But then you get to the next round and the institutional fund comes in and says, that's not going to work. Right? That number, that math doesn't work for our fund. And you can wind up hurting yourself by taking on too high a valuation in the early stages. So just make sure you understand who you're pitching to, because your investor is a customer. And what does that customer need in terms of return? And how does that align with your future planning? Not just this round, but the next round or two, because you may be a company that, I just need to get this $500,000, $750,000 raised. And I don't think I'll need to get any more funding. I can turn this into a pretty decent company with some returns for my investors. Then all you're really ever going to do is need to invest to a bunch of angels that are aligned with that, and you're done. But that might not work if you're thinking, well, the next round we're going to go for 2 or 3 million, and we're going to need an institutional fund involved. So a lot of characteristics there to think about.
Yeah, thanks, Arden. Well, I was wondering, can we maybe just take a moment and look at, Mike, your seed round, what you're willing to share kind of as a case study? Because I know you had angels and institutional VCs. Did you do some of the steps that you just recommended? Did you go out and talk to mentors and brainstorm valuation and just kind of arrive at what you thought was practical and then share that with the investors? How did it work for you?
Yeah. That's basically, so we had set the valuation before doing the round. So we had gotten advice on it from mentors. We'd built out financial models. We'd gotten lots of advice on our pitch deck and things like that as well. And then we knew that we wanted to bring a lot of angels on to that round and find for us, we always want to make sure that we're bringing investors in that also can bring in expertise and advice and help the company succeed in more ways than just capital. And so we also we went into the creative destruction lab at the same time as we were raising that fundraising as we were doing that round. So we also grew our network a lot and met a lot of angels through that, and that was a really important piece of that round. And like you said, we hit the pandemic in the middle of that round, and so it was lucky that we were in the creative destruction lab and growing our network and meeting lots more potential investors, because everyone's thesis started changing when the pandemic hit and lots of people were panicking and things like that. So it was but we didn't change our valuation. So that was an interesting one, because what we did do is make a lot of different, we made a lot of extra scenarios for the different ways that the pandemic could play out. And so that was how we kind of told that story of, here's different scenarios, this is what could happen, these are our plans, these are our contingency plans. And so suddenly there's a lot of extra risk. So how do we mitigate that risk? So we did have to suddenly add a lot of things into our story that we were telling that we didn't expect, but Yeah, and we looked at a lot of comparables and things like that as well to set the valuation, got advice on it, and we set a valuation that was reasonable, but not, it wasn't like an unbelievably huge valuation or something that, and we wanted to attract the right investors, right? It's not, there's all of those trade-offs. So
Yeah.
I'm happy with how we set it for that round for sure.
Fair.
And I'm really happy with the mix of investors that we got.
Yeah. Maybe is fair the word you're looking for? Like it felt
Yeah,
good to
fair.
you, felt good to the investors, everyone was happy.
Yeah. Yeah, exactly. Exactly.
Well, interestingly enough, there was all this talk when the pandemic hit about how, markets were going to tighten up. It was going to be a real challenge. Here we are talking about how like there's actually this, boon for the startup ecosystem over the last 2 years. And Mike, I feel like your company's actually a story of that as well. That in the end, the pandemic was, was that actually a challenge or a benefit to your company? I hate to call the pandemic a benefit, but
yeah, well,
you're in.
Yeah, I would say it's pros and cons. There's obviously a lot of challenges in certain things, when I look at our, budgets and things we'd set up, we had all this planned spending on in-person conferences and things like that. Suddenly there was no in-person conferences. So of course there's a lot of adjustments that had to be made. But for us, for the industry we're in, we did get lots of positive interest. We got lots of positive attention. It's definitely a mixed bag because there's also been these different waves in the pandemic. Sometimes budgets are suddenly tight. This year we saw in January, suddenly everyone was getting COVID. So like every deal in the pipeline slowed down a lot in January because there was just, this guy's out for COVID, he has COVID, so we got to talk in 2 weeks, etc. So and then suddenly things are picking back up again. So it's definitely been a mixed bag, but some of the positives have been similar to investors being able to meet virtually with customers all over the world. That was something we were doing before, but suddenly everyone is extremely comfortable with it. And there was opportunities I was hoping would pan out, like virtual conferences. Turns out they're not quite as good for networking and meeting people. Would have been great if that worked out because they'd be much cheaper, but turns out not so much. So we're really looking forward to getting back to more in-person conferences. And then, we've been hiring people remotely. We had done a bit of that before, but we've, grown a lot of people, a lot of our team in Edmonton, but also we've brought in talent across Canada. So and that again has pros and cons because lots of people are doing that. So now we're competing across Canada for talent at the same time. So it's interesting, but and then of course there's different accelerants in the pharma world. There's accelerants in the healthcare world. There's a lot of changes in these industries, and that means disruption, which means opportunity. So we're doing our best to be in the right place at the right time to provide solutions for those opportunities.
Yeah, okay, thanks, Mike. Well, one of the things I'm hearing here is like proper preparation. You can, in fact, do a bunch of homework and figure out what valuation makes sense. It doesn't have to be a black box. Arden, from my perspective, though, the investors actually have a lot more access to this data than the entrepreneurs. What's your advice to entrepreneurs as they're trying to like look at comparables, do their homework, talk to mentors? Where can they practically go for that information? How should they approach it?
Wow. That's a good point about the asymmetry of information available, right? Our firm has a subscription to PitchBook, which, it's not cheap, but that gives me access to quite a lot of data. The challenge is private market data is exactly that. It's private. And so whatever comes out is based on what the companies and funders decide they want to reveal. BetaKit has always got news announcements coming out, where, you can always talk to, try to get a hold of the founders and investors involved there. But also, talk to local investors who maybe, as Mike said before, who may not as a pitch, and not even as, they might not even be interested, someone that you would pitch for your fund, or a pitch to invest in your company as a fund, but just ask for some advice. The nice thing about the Alberta ecosystem, I will say, is that especially at the early stage, everybody is incredibly willing to share information, very helpful. It's not, a lot of sharp elbows and a lot of, well, if I'm not investing in you, I'm not going to spend time. We remain very accessible, myself included. And we're happy to have that conversation, as part of our participation in the community. So if you're serious and you're really in need, and there's lots of organizations, Startup TNT, for example, we have, different lecture series and stuff. So there's no end of resources. But I think the main thing that you can do for your homework, though, number one, is really understand who you're going after for investors and what they're looking for. And then asking yourself, is this the kind of path that my company can take? And being able to, it's understanding what they're looking for, and do you offer that, right? They're your customers. If you understand that, you're ahead of the game. If you're, you don't even need to know necessarily what the comparables are out there. You basically say, this is the trajectory my company's growing at. I think that we're going to let's work out a valuation together. And that's also an option. I know I need $1 million to get through the next 18 months. So what do you think is, what's reasonable? And talk to a few different investors, right? But there's no one way, I'm going to say, and you got to hustle as an entrepreneur to get that information.
Can we expand on this for a moment? Because this is actually a really important point that I think a lot of times we miss as entrepreneurs, which is, the valuation is sometimes a reflection of how much money I need to build this business, more than, say, fundamentals on how much, a multiple of revenue, which is not always, realistic at the stage you're asking. So can you elaborate on that? Because you just hit something I think is really interesting.
Yeah, I mean, at the early stages, before you hit significant revenue, which I would say is classified as anything under $1 million or so, it really is about what percentage of the company do you want to sell and what percentage of the company does the investor want to own. And if you're in venture, there are industry standards, right? Because we know that on average, you're going to go through 3 or 4 rounds of financing. And so, just as a rough guideline, your very first raise, if it's a small angel raise, friends and family, whatever it is, you're probably not going to want to sell. I wouldn't want you to sell more than about 10%, of your company, fully diluted. But then after that, once you get to your seed A, et cetera, it's on average about 20% at a time. So you keep that in mind, right? As you are looking for your valuation. And I always say, don't build a company for investors, build your company for your customers and for you. Figure out how much capital you reasonably need, and then you can work backwards from there. And I think quite often entrepreneurs can look at this as kind of like, I got to prepare and go out there and sell my company, pitch it. And it becomes kind of a negotiation. I won't say adversarial, but it's the kind of this 2 sides thing. And I mean, what would it look like for an entrepreneur to say, hey, I need to raise this much money. This is my company. Can you help me figure out what makes sense and make it more collaborative? You're all on the same side. You want to grow this thing so that everybody wins. That's entirely possible. That is absolutely entirely possible. And it's never too early to get in those kinds of negotiations or discussions.
I think, Arden, you're giving really good advice, because it's how much money do you need? And you got to break it down in chunks. Is it in the next 6 months, 18 months? What is it taking you to? Because sometimes I know there's a lot of advice being given to these entrepreneurs. Lots, and it contradicts one another. And depending if whether you've talked to someone down in Silicon Valley and they're like, oh, you can't just ask for $1 million here, you have to ask for 5. And then you come up to Canada and you ask for the 5, and we're like, you only need what, 750,000? Why are you asking for the 5? So it gets, I can only appreciate, very confusing and overwhelming. But Arden's giving everyone here on this call really good advice. It's break it down into these chunks of where it's going to take you to. And we tend to see a lot of cap tables with a lot of names. Some entrepreneurs are very diluted before they've even done their Series A, like very diluted. I don't think equity, I feel like they give it away. They even have put it through kind of the mathematical formula, because they think, oh, I just need the $1 million and then I'm going to be good. And we know, if you really want to grow and scale, venture capital investors, if you're going for institution, and this is what Arden's also trying to point out, is like, not everyone is going to be on the path to attract a VC investment. VCs are looking and creating unicorns. You have to become $1 billion operation. And if that's not your goal, and if that's not really your market potential, recognize that. That's okay. As Arden and BDC would say, it's okay to just have a really good business here in Canada or Western Canada. If you want to lock that down and that's your focus, I can tell you BDC will help fund you, but a VC won't, because you're not thinking big enough. You can't be big enough for them to get the returns. So some of it is acknowledging, what is your own business about? What is the pain that you're solving, that people have agreed that they'll pay to have solved. And so what is your real market potential? I think Arden and I see a lot of pitch books. It's always these billion-dollar marketplaces that they have, but your niche is only this or a certain percentage of that. Like just knowing what your real potential is part of it too. So what path should you be on? Should your path be more of a profitability and be a nice strong business, or are you going to be able to grow this and scale it and really become the next unicorn? And we had lots of unicorns in Canada last year, so it's definitely possible, but making sure, and there's a lot of pivots. A lot of the companies we see at early stage, you can change where you're going, but get as much advice as you can, and it will be contradictory. It will be overwhelming. Attend more events like this, so you get yourself educated. And I think, Zach, you put in the chat, like, you've got to research your investors too, because getting the highest valuation doesn't necessarily mean you have the right people aligned with you or around that boardroom table. So it's easier said than really done, but that's in the optimal situation. You're talking to a lot of people and getting that good advice that you can actually execute on.
And Brenda, that ties in really nicely in answering Kelsey's question about the inflation, you're seeing in the developer talent globally, because it comes down to, well, if you think this is what it's going to cost you, then that's how much you need to raise. That is part of the factor that goes into what we're seeing for inflationary valuation numbers. That's also one of the reasons why, for example, you'll see a seed stage company raise much more at a higher valuation in the Valley traditionally than you'll see here. But again, with the globalization of the access to talents and that inflation, that is a factor. So don't be afraid to come out and just say it. Like, this is what I'm going to have to pay. I've researched it, and that's what we want to see. And if we agree and that's realistic, then there's nothing to be ashamed about. That's for sure. And again, just understand that as an investor, I was trained. I always this is how I always put it: is develop my own perspective review of the world. Where do I think value is going to come from? What drivers do I see? How do I think the economy is going to affect it? Every investor has to do that. And so when Brenda said you're going to get contradictory advice and different that, it's true, because we're just people too, and we're all trying to figure out how things look from our perspective in the world. And your job as an entrepreneur is to see, figure out your own perspective and find investors that have that same alignment.
One thing to add is, when you're deciding how much to raise, you want to make sure you have some buffer in there as well for unexpected things like, interest or the inflation increasing, et cetera. You don't want to be so narrow that we're raising $750K and that we have exactly the right amount of money. You want to make sure you have a bit of buffer in there, because there's always something that doesn't go according to plan.
Which can also be non-dilutive buffer.
Yes, it could be. Exactly. Yep.
Yeah.
Yeah. Okay. Awesome comments, everybody. And just got to say, we're getting some really good testimonials here in the chat, Brenda, Arden, Mike. So thanks for all your comments. Are there any other, we got about 10 minutes left. Any topics from the listener base here that they want us to listen to or address, discuss?
I can throw one at Mike right now, actually,
Sure,
too, because we were talking about labor shortage, and BDC's latest economic report on the tech industry definitely came up that labor shortage is a big issue, as well as cybersecurity. There's quite a few topics, but one direction that the survey tech companies we were asking said M&A activity. They are planning to do a lot more M&A activity, and not just to acquire technology, but actually to acquire talent. So I'm just kind of curious, Mike, if in your world that's ever crossed your mind. And then I know, Arden, you probably have some saying from the different boards on whether acquiring talent that way is the right way to go. Yeah.
Yeah. For us specifically, we haven't considered that approach. I mean, we've invested a lot in building a really strong culture. We have an advantage, which is the thing that we're working on. The product we're creating is pretty cool, and it's a lot of people think it's exciting to work on. So, we've built a really great team. We provide lots of great benefits. We try to be competitive in that way and attract great talent in that way, and generate FOMO. We haven't, I guess, been in the position to really consider acqui-hires. I wouldn't rule it out necessarily, but I mean, that's just from our perspective, what we had done so far.
M&A is hard. People often underestimate and they think, oh, we'll just go buy that company, we'll acquire this and that. And most acquisitions fail, whether the goal was to get the talent, get the IP, and culture and people are the biggest factor. And at the end of the day, if business were run on simply algorithms and machines, sure, you could fold it in, it would make sense. But there's all kinds of dynamics. And whether it's at the private equity or public equity level, or all the way down here to early stage venture, it's not easy. And I think when Brenda and I were at the Lake Louise CVCA conference last week, and there was a discussion about this, and Irfan put it best, especially if you're so Irfan Raji, partner at Relay Ventures, especially for early stage companies, when you're young and scrappy and you're just like, why are you buying it versus developing it? What is stopping you from developing it? Which is a very good and fair question. Yeah, I mean, talent is hard to get, but there are, like I said, there are other considerations. And never forget that on the one hand, large companies with massive resources are having problems absorbing people into their organization. How are you with 10 people going to absorb another company, even with 50 people? So you better really have a good understanding of what that entire M&A process looks like and the resources it's going to take up and the time it takes, and whether or not your time might be better spent maybe coming up with some more money to pay, pay higher wages for the people that you need and look in non-traditional markets. It's not as simple as an acqui-hire and like, okay, we'll just go buy that talent. If you're Google, you can do that. You have the resources. If you're Drugbank, that might be a distraction, right, Mike?
Yeah, exactly.
sounds like a warning from the investors under there. Remember what to focus on.
Well, yeah. I mean, I imagine when you're a larger company, the equation changes at some point, but I don't think
it's still not smooth. Like Arden's right. The integration every company I funded with like mergers and acquisition, you first see the results go down before they start coming back up. So it's not just an immediate synergistic value and add-ons.
Okay.
Yeah.
I'm gonna give the audience a second to ask one last question. Otherwise, I'm gonna throw it back to our panelists for a question of my own. So I'll give them a second here. And I'll let you guys know what question I'm thinking of, which is, what is maybe a prediction or a trend that you think we should all be looking out for in 2021, either here in Alberta or globally in the startup community?
You mean 2022?
Am I a year behind, Arden? Am I a year behind? I do mean 2022. All right, Emma has a question. Are you evaluating a company right now, or what's going to be worth it at the end of the investment period, or maybe a combination thereof?
Oh, I see. Okay. I'm kind of confused at the question there. Are you looking at a company based on its current metrics or what's ever at the end of the investment period? It's both. Investing and understanding value is really an exercise in looking at where you are now and where you could be and figuring out the difference. I mean, classically, when you look at valuating a company, it's really the net present value of all potential future cash flows, to time zero, which is now, and that's how you kind of figure out what the value of a stock would be. Now, as simple as that sounds and straightforward, there's all kinds of witchcraft and voodoo that go into that. The world of finance is not as cut and dry as we might think. But the point is that we do need to triangulate a few different points to figure out what could we potentially make on this, right? What's our potential return? And that kind of helps us to figure out, is it worth getting in now? Anybody who goes into investment blindly without thinking about how am I going to make money on this isn't really an investor. They're doing philanthropy.
Yeah. And not just what it's going to be worth in the future, Arden, like you said, sometimes you guys are evaluating like how much heavy lifting am I going to have to do to get there? Because some companies aren't a straight path. Sometimes it is like, I will have to bring in this expert I know and this to help round the team out, and we'll have to see this happen. So there can be a lot of heavy lifting that's going in by your partners. So they will take that into consideration as well. So that maybe would speak to where you are today, how much you've built of your management team or your revenue traction, where you're already at.
Okay, thanks, Brenda and Arden. Anything to add to that, Mike?
I would say different investors also have different, I guess, tolerance for I guess the probability they're looking for. So some might want to see 1 in 10 be a huge success. Other groups are looking for, they want to like half their fund to be a pretty good success, and they expect some companies to fail. So that's another part of it of when you're kind of selecting the right investor, you want to make sure you fit their risk profile too. If you have a really risky company, which could be worth billions of dollars or $0, but it's a huge risk. Some investors just won't even be, they're just not the right fit. So that's another important part.
Okay, thanks, Mike. Barry asked a very practical question that I think Arden might have actually hinted at. What percentage of equity are seed stage investors looking for? Arden, you had mentioned 20% dilution of the founders is kind of typical.
On average, fully diluted at the seed stage. Percentage wise, that's roughly give or take. But again, it comes down to what do you need the money for and how much do you need? I've seen seed valuations anywhere from 4 million, 5 million, all the way up to 40, right here in this in this market. So it varies. It depends on the industry you're in. So I'll give the standard lawyer answer of it depends.
Good, but correct answer. Okay, guys, 2 minutes left. Who wants to talk about trends? I want to spend at least 2 minutes talking about trends. What are we going to see in Alberta? Are we going to see more VC funds? Are we going to see higher valuations? Are we going to see more capital raised? Are we see bigger Series A rounds? What are we going to see in Alberta? Who wants to make a prediction here? Edmonton versus Calgary.
I'm going to say yes to more VC funds because we know Alberta Enterprise Corporation, they've been doing a lot of due diligence on funds right now. So it sounds like they're very active. So I think that was a safe bet.
I think more VC funds is definitely a safe bet.
Yeah.
I think it's going to get more competitive for entrepreneurs, not only because of the the more discerning capital, we'll say, but when you look at the number of accelerators, that are popping up here and what they're trying to crank out. Now, we all know that 80 or 90% of them aren't going to be, survive and be great quality necessarily. And that's the way it goes. But that means you as an entrepreneur are up against you have to stand out. And suddenly, the noise to signal ratio just changed. And it's going to change in the next year or two. So fundamentals don't change, right? Build a great company, have some beer, make some new friends. Whatever.
More competitive, but inevitably, I would say good for us all, though. More sophisticated, more competition. We all have to up our game here.
Absolutely, because that's how people will get more literate and learn more, and then take their lessons and go build other companies down the road. So it's not a bad thing. It's just the changing environment, and we're all going to have to, be mindful of it as we do our jobs, if you will.
Yeah, Mike, I'm gonna hand one softball to you. Calgary keeps being in the news for their Series A rounds. Is that trend going to change? Are we going to see some Edmonton companies in the news?
I'm sure we will.
I'm sure we will.
But I think, there's lots of companies here growing quickly too. So, the more successes in Alberta, the better. The more entrepreneurs also kind of push and strengthen each other and provide wisdom and insights to each other as well. So I think
a shout out for mentorship too. I like it, Mike. Friendly competition. Let's go Edmonton. Let's go Calgary. Let's go Alberta. Let's see some more investments rounds raised here in our province.
We just got to accept and be proud of what we are here, right? I mean, Edmonton and Calgary are two very different markets and two very different economies, and I don't think it's wise to try to compare the two or try to catch up to one or the other. We're going to have different kinds of companies and a different kind of community here than they do in Calgary, and that's all right. That's great. It should be that way.
Yeah, fair point, Arden. Always wise. This is why Arden's a full-time mentor as well as a VC. He's got words of wisdom that we shall be living by. So thank you, Arden. Thank you, Brenda. Thank you, Mike. This has been a great session. Lots of positive testimonies in the chat here. Everyone have a great afternoon. And join us to the Investment Summit Thursday, where there will definitely be more investments happening right here in Alberta. So thanks, everybody.
Thanks for joining.
Thanks.
Bye.
Bye.